Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview webinar, so every other week, of the market's key events and trading opportunities. Whilst I just let you have a look at the disclaimers, I'll just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Our goal is also to break down all the market jargon and complexities that you read about. So if you do have any questions, please do ask them along the way and write them in a box, and I'll hopefully answer them as soon as possible, or at least after the webinar finishes. Okay, it's Wednesday, June the 5th, just after 11 a.m. in London time. Let's just see how markets are shaping up currently. That's what we'll do first of all. We'll then just check out last week's main events, which include, of course, the inflation data out of the Eurozone and the US, the core PCE data, which is the Fed's favored inflation gauge. We'll look at a couple of charts around that before then looking at this week's main events. Some big risk events, of course, with the ECB meeting, the Bank of Canada meeting shortly in a couple of hours' time, in fact, and then wrapping it up on Friday with the non-farm payroll data. That's the US monthly employment report, which is always, of course, a big risk event. Okay, I'll just first of all just check how markets are doing currently. And we'll just check out a couple of charts. First of all, I've got the S&P 500 here, but generally stocks relatively cautiously higher. Just checking futures, actually, futures being, just a touch higher. Haven currencies have been in demand this week. The yen and the Swiss franc outperforming. Commodities, they've been declining. And as well, 10-year treasury yields have been declining as well. That's been the big move really for us this week. If I just actually look at that 10-year treasury yield, this is the US 10-year treasury yield chart. You can see declining for 4 days on the spin, consecutive days of losses there, and now into this really strong level of support for us. This previous cycle high tallies with the 200-day moving average as well, around sort of 4.33, 4.35%. This is the 10-year US Treasury yield. Remember, this is a global proxy for borrowing costs, so really does drive other markets, and this is why we like to look at it. You could just see possibly a double top as well, with the sort of neckline being around this, reinforcing really this point around sort of 4.33% or so. So just watch that. It really interesting as we come into non-farm payroll, of course, whether we oscillate around here and then bounce off or decisively move down below if we do get a softer print or softer report actually on Friday. As for the dollar, you can see similar kind of chart in a way, but we have broken that sort of trend line that we've drawn in here, that dotted line from the lows in December, touched a few points, so relatively decent trend line, upward trend line being broken on Monday. We're just sort of trying to get back sort of into it and above it possibly, but you've got the 200-day moving average there as well, which is of interest. We did have that, first of all, a load of employment data. We had the JOLTS data, the job US vacancy data yesterday. And dollar really gained strength initially before reversing really yesterday on the back of that softer data. But then it sort of made gains after that just because markets assessed that some of the other jobs data was sort of unchanged really, with a quits rate, I know, a focus for the Fed, and an indicator for wage growth, really, that being unchanged for the 6th consecutive month, I think. Lower yields saw havens outperform, as I said, so you had dollar yen slid below 155, although it's just up to now 156 or so. We have had reports BOJ considering tapering its bond buying at its meeting on the 14th, next Friday, that is. We've also had dollar Swiss as well. That dropped down to 89 or so. Don't look at this chart often, so let's look at that. So you can see consecutive days of losses now. Just the black line there, the 200-day moving average at 88.92. So just bounced off that. Just seeing whether that has any sort of relevance, really. A little bit here of resistance. So potential support around that 200-day moving average at 88.92 for dollar Swiss. That comes even as, in fact, Swiss core CPI came in unchanged actually recently, against expectations of a slight pickup. So suggests the S&P's June 20 meeting could be, options are remaining open for that meeting. Commodities, they've been a big mover as well. Oil prices have dropped. Just pull up the chart here. You can just see that fall, quite sharp fall. Really on concerns about increased supply and then weak US economic data, of course, unsettling the markets. Really sort of 72.50 is very, very strong support, so it'd be interesting if we get down to that sort of level. We are oversold on that daily RSI, so possibly a bit of a correction rebound in the offing as well. Copper, interesting, because of course that spiked higher last week on really speculative forces, but then dropped quite sharply, and futures are now down again due to low demand, really, particularly from China, and that's a sort of bigger long-term picture, as well as ample supply. Prices are sort of up around 15% year to date, driven by sort of expectations of potential shortages. And of course, then the metals role in infrastructure products and AI or EV vehicles, and the move to green energy, of course. So yeah, mixed picture really for copper, but longer term drivers as well. If we just have a look now at stocks, they traded with some intraday volatility yesterday, really. As I said, it's kind of initially selling off due to that drop in job openings to 3-year lows. Actually, they were signaling potential deceleration in the labour market. But then, as I say, a sort of slight reassessment with some of the details in that jobs report, the JOLTS job vacancies report, and that quits rate being unchanged. So markets really, they paired those losses as the day progressed, and sort of rallied quite sharply late afternoon, actually mirroring the prior sessions pattern as well. Kind of surprising, markets haven't reacted sort of stronger really to the big decline in treasury yields that I just showed you about. That 10-year yield dropping 20 basis points really to that 4.33 level, 4.3 the low. Market expectations for interest rate cuts in September risen now actually above that sort of 50-50 line to around 65% now for a Fed rate cut in September. But really for equities, oil majors have led, made going probably a touch more difficult, and I've showed you that sort of fall in Brent crude prices really affecting companies like Exxon, Chevron, and ConocoPhillips. So just on the S&P 500 technicals, then you can see, previous cycle high around 52.64, and we just sort of dipped below that, nearly touched that blue line, which is the 50-day moving average of 51.82, and now we're back above that sort of previous cycle high, potentially then looking at that record intraday high at 53.41. For the Nasdaq, kind of similar, dip below that cycle low. You can see quite a bullish candle really, even though we closed marginally low on the day, but really buy stepped in when we did dip last Friday, and then we pushed above that previous cycle high, and we're looking solid 4 more gains then potentially to that intraday high at 18,907. Dow, different picture. Defensive's been struggling, tech and Nvidia obviously with continuing record highs actually in Nvidia, pushing up the Nasdaq, helping wider stock markets, but not the Dow, obviously, with its 30 components and much less tech and more defensive. So you saw big sell-off, sort of 5% sell-off from the high to the low, late May, of course, and then we just had that rebound off sort of 38,000, and we're just sort of tracking sideways now around 38,559. I've got some fib levels in here. You can see potentially resistance at sort of the halfway point of this move at 38,848. But otherwise, potentially, if we keep this downward momentum after sort of easing back slightly, then 38,000 for sure is a big support level. Okay, let's go now to last week's main events. First of all, we had, well, we'll look at US core PCE data. As I said, that's the Fed's favored inflation gauge. That rose 0.2% month on month, so lower than the prior, and then 2.8% year on year, which was unchanged. The consensus was sort of 0.2, 0.3 all week due to really inputs from PPI data and CPI data as well. And certainly then decimal places are kind of coming into play here. The actual print was 0.249%, so not far off 0.3, but rounded down to 0.2. But really sort of 0.17, if we're getting into this, is really what economists cite as being needed to soothe the inflation worries of the Fed over a number of months. And we've not had that just yet. Yeah, for a September cut, certainly then as well, you kind of need further slack in the jobs market. We'll look at that number, the non-farm payrolls soon, and then more evidence really of cooling consumer spending for any chance of that pickup, well, in the Fed rate cut, obviously, which is now, as I said, around 65%, and had been oscillating around a sort of coin flip for the last few weeks. The report on the inflation measures, the other data was actually weak as well elsewhere, with consumer spending soft, so negative 0.1% down from a revised plus 0.4% prior, and real household disposable income actually down for the second time in 3 months. So that was the US inflation data. For moving on then to the Euro area, we had obviously CPI data as well. That was out on Friday, last Friday. HICP, CPI data essentially in the Eurozone for May, that came in slightly higher than expected. So 2.6%, the headline prior was 2.4, consensus expected 2.5. And that higher number was in line with signals actually from country data released a couple of days prior to this region's number. Core inflation, what policymakers focus on, that printed higher as well, 2.9% prior 2.7, and consensus expected 2.7 as well. And then obviously the big focus is on services inflation. That once again came in very strong, actually rising to 4.1% from 3.7%. So it really remains elevated for now. Interesting sort of forward-looking indicators do gradually move in the right direction. And if goods demand certainly returns on the back of higher real wage growth, then goods inflation also actually could accelerate somewhat again towards the end of the year, as supply chain problems still modestly curb supply. But yes, there are certainly questions around wage growth as well. We had those figures a couple of weeks ago, and they surprised to the upside for Q1 negotiations. And that really is a key element in bringing down inflation. ECB, they did dismiss those sort of that one-off figure due to one-off payments really in Germany, as other countries really see faster deceleration in wages. But still, we have to say unemployment, that remains at a record low of 6.4%. So really a sort of decline in wage growth potentially over the rest of the year remains quite uncertain. Going forward for inflation, at least, economists, they expect, well, the headline to sort of hover around 2.5% over the next few months due to rising energy inflation, sticky services inflation, as we mentioned, and then after summer, potentially headline inflation expected to hit the 2% target. in some months due to energy base effects. But then the sticky underlying core inflation means it only sustainably could converge to the 2% target towards 2025. That's for the core. We've just got a chart here as well, just before those prints. So you can just see falling prices, a disinflation process continuing, but then we had an uptick in both the headline and the core as well. Yes, so that's Eurozone CPI data. Let's now move on conveniently to this week's ECB meeting. We should just got a preview here of all the numbers. Which you can see here, just checking that you can see that. Yeah, you can. Yeah, so ECB widely expected to deliver this sort of well-telegraphed 25 basis point rate cut, essentially because the governing council members have stated as much in the last few weeks. We also do get the latest updated June staff projections. They're expected to suggest really the prevailing economic and monetary policy narrative really stays broadly unchanged. So the cut will probably be seen as a kind of hawkish cut, however obtuse that sort of sounds, and really sort of a rollback, if you like, of, if you remember, that insurance type hike that we saw September in 2023 last year. If we just go back to the April meeting, then obviously the ECB kept rates all unchanged for a fifth consecutive meeting. But the statement was altered again to really offer yet another clear steer that the governing council would look to begin cutting rates in June. That's essentially what we've heard from over the last few weeks, as I say, from most governing council officials, and also then that statement from last time reiterated that fact as well. For this meeting, the governing council probably will retain an easing bias, but then they will definitely want to not be specific on when rate cuts might happen further, and really then reaffirm this idea around being highly data dependent. I think you'll hear that a lot, and especially from President Lagarde during the press conference. Of course, that latest inflation data really adds to doubts, as we just said, about the sort of future inflation path. Some or quite a few forward-looking indicators remain relatively benign, but then we still have this sort of relatively hot labour market, low unemployment, decent wage growth, continued supply chain disturbances, and then a sort of recovery of purchasing power that really sort of add to this mix and the debate at the governing council, at the ECB, about obviously the future path of monetary policy after this one rate cut. So it's kind of one and done potentially, is what some economists are asking, or at least for the next few months and post-summer for sure. Core inflation, as we said, sort of seems set to decelerate, but the question really is at what pace, as we said, and what happens if it does tick up. Really, so that the May data, the HICP data, really serves as a warning that most likely this isn't the start really of a traditional cutting cycle, with a series of rate cuts, one meeting after another, back to back. That's unlikely, and again, data dependency, cautious and gradual, probably the watchwords here, and to focus on anything different from that would be a surprise really, and see volatility in markets. Money markets, anyway, they have really nothing extra priced in for the July 18 meeting, about 10% chance of another back-to-back rate cut, essentially, so very unlikely. And then there's about a half of another 25 basis points cuts priced for September. So really there is scope for some near-term sort of forward rate path to be impacted by any guidance. Certainly, though, if we have a lack of guidance, then will that be seen as hawkish potentially, possibly, and that would then help euro and euro dollar. I'll just show you. Let's just go to the euro dollar chart actually now. If I just pull up the chart, which is here. Yeah, so just checking, you can see that. So you can just see, yeah, euro dollar sort of decent bullish trend really from those lows around 106 in sort of mid-April, got up to 109 yesterday, 109.16, but just struggling around that level at the moment. We've got some long-term fib levels in here of the Q4 rally. And yeah, there's a 38.2 at 108.75, kind of capped resistance, capped at the upside previously as well. So that's an interesting level before 109. If we do move above here, then certainly you've got the next minor fib level 109.76, which tallies with that high from March at 109.81. Otherwise, if we do dip lower, then yeah, you have the halfway mark of this Q4 rally at 107.93, plus these long-term moving averages actually interestingly as well. So the black one, 200-day at 107.87, and then just below that, the 50-day at 107.75. We'll move on now to the BOC. So Bank of Canada meeting, we'll just pull up the dollar CAD chart here. Fairly uneventful, but the Bank of Canada now most likely to cut rates by 25 basis points. There's now, I think, over an 80% chance of a cut. Last week, I guess, middle of last week, it was more of a undecided decision potentially. And I know some of the big Canadian banks, 3, I think, are advocating a rate cut, but 3 are saying that the Bank of Canada will stay unchanged. So a little bit of difference there. The April meeting, the Bank of Canada, they kept rates on hold at 5%, though the messaging at that press conference took on a more dovish tone, really setting the stage for these future cuts potentially. Since then, domestic data, that's continued to move really in the right direction. The underlying disinflation process has continued. So I think it's now 1.6% is the 3-month annualized in April for the average of the Bank of Canada's 2 core inflation measures. So well within their 1 to 3% sort of target band. And headline actually fell to a 3-year low at 2.7% in April. Economic growth kind of been sluggish. Labour market has cooled a touch, even though job market gains have been pretty solid, and we do get another update of those on Friday actually. And then some economists actually interestingly cite the sort of wider shift in expectations surrounding the Fed over the past couple of months that sort of may cause the Bank of Canada to hold off and see what the Fed does. But then, of course, we have had that sharp downturn in yields very recently, as I showed you at the top of the webinar, similar in global yields elsewhere, of course, and also Canada. So that's why that chances of a cut today have ramped up. So definitely there's been progress in domestic data and in the disinflation process, and that is probably what will shift the Bank of Canada into a rate reduction later today. Interestingly, again, it will be about guidance, though, as well, whether this is the start of an aggressive rate cutting cycle or not. Most likely not, but any sort of difference to that would be a surprise for consensus, I would say. And certainly then, you know, the uncertain backdrop going forward, especially with the Fed, will be something to note and something to listen out for with Governor Macklem and what he says about certainly the next door neighbor and how they are potentially going to deal with things. That is the FOMC, the Fed, of course. As for dollar CAD, sort of tracking sideways, so just waiting for a catalyst, which obviously could be today, or obviously then non-farm payrolls and the Canadian employment data out on Friday at the same time. 50-day moving average, that's at 136.64. We've got strong support around this level at 136.23, and then upside probably capped around here 137, mid 137s essentially are the levels to look out for on the upside and downside. Okay, I'm just going to now move to non-farm payroll and the graphic here. Interestingly, really, because last few weeks we've had sort of US price data, inflation data, core PCE data, which the markets are focused on. This week, really now all about the second part of the Fed's dual mandate. That is, of course, maximum employment. We've had that JOLTS job opening data, kind of mixed, but underneath the hood, really sort of unchanged. Um, um, and really then we have ADP today, which is really of no significance for non-farm payrolls. And just generally employment data, of course, goes to the heart really of the Fed's focus of balance returning to the labor markets. That's what you'll hear. Hopefully, if numbers come in line with consensus on the NFP, then the market is balancing better between supply and demand. Lower job openings will reflect that better balance and really then have implications for how the Fed thinks about labor demand and then, of course, wage price pressures as well. For the report then, 180, I think, is around consensus at the moment. The April report, that showed a 175 increase, so that was below consensus expectations, but still kind of consistent with the broad range of monthly increases seen over the past year. Interestingly, I think, just looking at the other numbers to expect, 3.9 for the unemployment rate, so that's holding steady. 4% is what the Fed sees at the end of this year, but that forecast is updated when we get the Fed meeting next week, of course, along with CPI as well. You've got monthly wages, pretty benign at 0.3%, and I think the year-on-year number will come in around 3.9 expected. And then you just got that pickup in the chances of a Fed rate cut, moving from a sort of coin flip to around 65% or so at the moment. I've also put in there actually job growth from previous years. So blockbuster obviously in 2022, this is the average 377 on the headline number, 251 in 2023, actually popped up in the first quarter to around, I think it was 269, the average 269,000 for the first 3 months of this year. But then obviously we've had that 175 print and then 180 on the headline expected on Friday. Labour force participation rate as well, that's expected to hold steady at 62.7%. An inline print probably feels fairly good for markets really, potentially could react quite positively, certainly if the number is lower, but too low, we kind of wonder whether then markets will get slightly worried about an incoming sort of soft landing or something slightly harder. Next week, of course, as I mentioned, we do get the FOMC, but generally economic data has sort of signaling a sort of very gradual slowdown. It is coming, but it is gradual, is probably the point. But a softer report, of course, would bring forward those potential ramp up, those soft September rate cut odds as well. I've just got a data chart here as well, which sort of shows you a bit of everything really. So the bar chart is the headline non-farm payroll number, sort of below 200,000 there. You can see after the pop higher in the first 3 months of the year, as I said, 269 average, I think, for the first 3 months. Then you've got the unemployment number, as I said, ticking up slightly, but probably we need that to be above 4% really, for really a rate cut to be definitely on the table. And then you've got the orange line, which is CPI, slightly sticky, and then average hourly earnings sort of moving down to sort of the 0.3%, 3.9% year-on-year number, that is. So that gives you a picture of where we are on prices and obviously on employment as well. If we just go to the DXY chart, let me just pull that one up. which is, remember, has a heavy weighting to the euro, around 56% or so. So again, we looked at it before actually, but you can just see we've broken down through that long-term bull trend line, broken through the 200-day moving average as well. That's a 104.43. So interestingly, whether this is a proper break or a false break even, and then we move back above the 200-day moving average towards that 50-day, which capped the upside recently at 105. 105.08 is a 50-day. So interesting whether interesting point for the dollar, certainly, with 104 sort of being, initial support before then maybe a sharper move lower. But much will depend on the non-farm payroll report. And then, of course, as I say, the Fed next Wednesday on the 12th, and as well, US CPI data released on the same day. Okay, I will wrap it up there. Thank you so much for listening, and hope you enjoyed this webinar. Please do follow us, and we will speak to you the same time in a couple of weeks' time. Okay, take care out there.